All right, guys, today we're going to take a look at CrowdStrike. This is a very popular growth stock. I'm going to break down the fundamentals and give you my thoughts if it is at a good price, if we should be buying it as of today, or if the price needs to fall down further. I'm also going to go over the chart, break the technicals down, and give you my thoughts of where the price could be headed from here. So let's jump right in. What's up, guys? Welcome back to This Just In. Thank you so much for joining me today. My name is Justin. I am your host. In today's video, we are going to take a look at the CrowdStrike stock. This is a very popular growth company. They do cloud security against data breaches and things like that. A lot of people have been asking me if this is a buy at these levels because it is down about 40% from the highs. So I'm going to go over the valuation. I'm going to go over the fundamentals. I'm going to go over the discounted free cash flow sheet. And I'm going to give you my thoughts if it is a good price at these levels or if it needs to fall further. I'm also going to break down the chart, go over the technicals, and give you an idea of where the price could be headed from here so you know what I would do if I was going to buy it or if I was going to trade it. Real quick, before we get started, subscribe to the channel if you're new around here and want to see more videos like this. Come over and join us at the Patreon if you want to see all of our trade setups. And Day One Squad, I love you so much. Thank you for your support. But let's get started, guys. As you can see here, guys, when it comes to revenue growth, they are absolutely killing it. I think their market cap is about $38 billion as of today. So it is a large company. And you can see back in 2017, 52.7 million in revenue, scaling that all the way to 1.45 billion in 2022 full year. So that is insane growth rates. If we look at year over year growth, their growth rate is slowing, but when you go from 50 million to 1.4 billion, you're obviously going to see slowing growth rates. You cannot maintain 100%, 125% year over year growth. You can see 125, 110, 92, 81, 66, 43 in their trailing 12 months. So those are still insane growth rates. And if, as long as they can continue to maintain anywhere close to that 40-30% mark for the next 5 to 6 years, that's huge, guys. When it comes to net income, they're negative and their losses are widening. They're not narrowing. As you can see, they did negative 91.3 million in 2017, but in full year 2022, they did negative 234.8 million. So that's kind of an issue. You definitely want to kind of figure out, why are those losses continuing to widen? You want to see companies with growing revenue narrowing losses. We got to see them get to that point where they're starting to make money on the bottom end. I don't know why their net income is continuing to widen. That's something you would need to look into. However, it's negative as of today, so they have no PE ratio, so we can't look at that valuation metric. If we jump over to the balance sheet, guys, we want to look at the health of the company. Total current assets, 2.733 billion. And total current liabilities, 1.497 billion. So they have more than enough cash on hand to take care of all of their debts and be just fine. Now, when we look at the shares outstanding, you can see they were 40.5 million in 2017. I'm not sure when they IPO'd. I think it was 2019 or 2020. So we'll just look at from when they had this huge jump right here in 2020. So they went from 47.4 million from 2019 to 2020. That was probably when they IPO'd. And then 213.2 to 232.1. So they have been issuing shares for the last 3 years, about 9% in total from 2020 to 2022. And then their last reported trailing 12 months. So, and it makes sense. Obviously, with the market conditions and all of the stock prices way overvalued, I would, as a CEO, continue to issue shares at the higher prices. And as the stock price falls, who knows, maybe they'll try to buy some back. But you got to see the issuing of shares start to slow down. You do not want to continue to get diluted. Next thing, guys, is the cash flow statement. This is definitely my favorite thing about the company so far. Their cash flow is insane when it comes to year over year growth, average growth. It's beautiful. As you can see, in 2017, they were about 58 million in the negative. When you look at full year 2022, they did, little over 464 million in positive free cash flow in 2022 full year. And then in their trailing 12 months, they've done about 503 million in free cash flow. Beautiful. Free cash flow is cash from operations minus capital expenditures. So guys, if you look at that growth rate from negative 58 million in 2017 to 500 million in their trailing 12 months, that's insane. Now, there is a big discrepancy between net income and free cash flow. Those are usually supposed to be pretty synced up. So definitely something to look into. What I would think that it is I would think that it is their reoccurring revenue model. That's why they've got so much free cash flow, but maybe there's something coming out after the free cash flow into the net income that's making it, go into the negative, whether it's stock-based compensation or whatever it is. Something you would definitely want to look into though. This is what I love so much about the company, guys. They are a reoccurring revenue business. I have said this many times. Reoccurring revenue is everything in my mind. Any business I've ever, built or started to build or want to build is reoccurring revenue because you've got, consistency. As long as you can build up your accounts, you can provide a good service. It's something you can rely on as you go. I'm not a big one and done type business, guy. I like to see consistent revenue going every month. That's just, you set it and forget it and it keeps coming in. So I love that about this company. Look at how quickly they are growing their subscription accounts. They had 1,200 accounts in full year 2018, and they are currently sitting at almost 18,000 accounts in their first quarter of full year 2023. And they've grown 57% year over year. That is insane, guys. They are growing their subscription base at a huge, huge percentage. If we look over here, you can see 65 of the Fortune 500 are in their, subscription clients, 254 of the Fortune 500, and 15 of the top US banks, top 20 US banks. Guys, look at this. So annual reoccurring revenue is the ARR. Look at how insane that growth is from first quarter 2018. This is revenue. We just looked at customers. How many customers? This is revenue. So they are currently at $1.922 billion on their annual reoccurring revenue. That is beautiful. The green is the new client or new revenue that they're bringing on every quarter. You can see 61% annual reoccurring revenue year over year growth rate. Massive, guys. If they can continue to grow that, that's everything you want to see. So I'm not a huge fan of why their net income is in the negative, but I love the fact that they are growing their annual reoccurring revenue at a very, very fast rate. If they can continue to do that, that's huge. They also, their retention rate, guys, is like 98%. It's insane how quickly they're growing it, but also maintaining and retaining those clients that are paying them monthly. I also like that it's a small ticket item. It's not a few clients that pay a ton of money. It's a lot of clients that pay a little amount of money, because if you have cancellations, it doesn't hurt as bad as when you've got, 200 clients paying a ton of money every month. So I really like that. There's a lot of companies out there that their reoccurring revenue is massive amounts of money for one client. So when you lose somebody, it hurts. Okay, guys, let's jump over here. So let's kind of recap and look at our checklist. For those of you guys that are new to the channel, these are kind of the key metrics that I look for. Like I said, 38 billion on the market cap, guys. When it comes to 5-year compounded annual growth rate on their revenue, 64.9%, obviously green, perfect. That's what we want to see. 5-year net income compounded annual growth rate is red, no go, negative 11%. Free cash flow, 5-year average growth rate. So this is different than compounded annual growth rate. This is what they've grown their free cash flow on average for 5 years. You take their growth rate year over year over year, and then you add it up and you divide it out and you get an average. 323% is what they have grown their free cash flow year over year on average for 5 years. That's massive, guys. So huge green, green there. Next thing on valuation metrics, because their net income is negative, no PE. So we can't look at the PE ratio. The next best, better is the price to free cash flow. Way better than the PE, in my opinion, 58.9. So definitely a little pricey there, guys. Way overvalued, in my opinion. I like to see it around 20. Because they're growing so quickly, you could potentially offer them a premium, maybe give them 25, maybe 30 on their price to free cash flow. If you use 20 and did a 10 or 20 times multiple on their free cash flow, their desired market cap would be around $10 billion. So literally a third of what it is, less than a third of what it is today. So that would put your target price, if you used price to free cash flow at a 20 times multiple, around $43 a share. Now you don't have to use that metric. Again, like I said, you can give them a premium. We can look at other, metrics, but that's $50, $60 is where I would like to see it. But again, most people probably would say, oh, it's never going to fall that much. But I think 50, 60 times free cash flow, way too much to be paying for it as of today. Let's jump over and take a look at the discounted free cash flow sheet. To kind of get an intrinsic value, we want to look at future cash flow, discount it back, and create a present value. If we look at revenue growth, guys, it's insane. Analysts are expecting them to grow at 52% in 2023, 36% in 2024, 30, 37, 24, 21. So analysts are expecting them to grow over 30% on average for the next 5 years. The reason why I'm showing you that is because that's the number we put in on our discounted free cash flow sheet. We want to put their growth rate for the next 5 years. I've got it sitting at 30%. So a little bit less than what analysts are expecting, but we want to be a little bit conservative. Now, when it comes to the free cash flow margin, they are currently doing 30% on their free cash flow margin as of today. And that's actually their target of where they want to be as well. So if we want to just kind of put it where they're at, we're going to put it at 30. That comes up with an intrinsic value of about $111 per share. So 33% downside of where it needs to go. I honestly think that's even being a little aggressive, guys, because putting 30% revenue growth for the next 5 years, everything has to go right. Everything. I would rather be more conservative. That's also making sure that they do the absolute best on their free cash flow margin, which is another thing that is kind of hard to, rely on. Guys, when you're making an investment in a company like this, you want to plan for the worst case scenario and hopefully they do way better, right? You don't want to plan for the best case scenario and then they don't hit their metrics. If we drop the free cash flow margin down to 20% and bring our growth rate down to 25%, $62. That puts it right about what we were saying with the price to free cash flow. So guys, that's all up to you. You can kind of figure out what numbers you want to put in there. But for me, I would like to see it fall around 60 to $70 at the least before I even start looking at it. Now, if you're dollar cost averaging into it and you believe in the company wholeheartedly, you think they're going to absolutely kill it, hit all of their numbers, then sure, buy it all the way down. If it's going to continue to fall, whatever. If you are wanting to buy it like once and hold it for the long term, I definitely think you need to see it fall further. And honestly, if I was going to dollar cost average into it, I would even wait. I love some of the things they're doing. I don't like the valuation. I would like to see them do a couple of things a little bit better before I started putting my money into it. For all the CrowdStrike fanboys out there, guys, I'm not dogging the company. I'm just saying, from my perspective, in order for me to put my money in it as an investment, I don't think that there's enough potential upside for the amount of downside risk potential. I would like to see it way further down because then that minimizes your downside. But let's go ahead and jump over and take a look at the chart. So the chart's not too bad, guys. I mean, honestly, it has not gotten beat down nearly as bad as a lot of the other tech stocks. You can see it hit a high point back here in November of 2021 at almost $300. It was like $297.40 was the all-time high. And then it is down about, so it's 173 right now. So it's down about 42% from that high. Now, I want to point a couple of things out, guys, because we just did some pretty fantastic things. You can see here the initial all-time high from back here in September, okay? Right there at 153.90 to 162.89. That's your major inflection zone. You can see here, tested it as resistance, dumped, resistance again, dumped, tested it, resistance, got above it, back tested it as support before going to the next zone, which is up there at around 225. Really nice. Price has correlated to this level many times since. So once you broke it, went to the top of the zone, straight back down to back test it before running to the all-time high. When we dumped from the all-time high and made a lower high than the previous high, we came back to that level. We caught a reaction off of it, and where did it go? Right back to the top of the zone. And when it back tested the top of the zone as resistance again, it also back tested the 200-day moving average. Then it dumped and broke the inflection zone. Check out how it broke the zone, back tested it as resistance a few times, then sprung and back tested the spring successfully before reacting off of it. So guys, if it stays above 153.90, I think you're in good shape. Again, that's that high from back here in September. If you break 53.90 and back test it as resistance, I think you're headed to 99 bucks. I mean, that's the IPO, the first initial all-time high from back in 2019. That's where you're headed. If you break that level, I'll see you at 100 bucks. That's where I would like to see it go, guys. If it could get down to that $100 level, that initial all-time high from 2019, I would be pretty interested in watching it and seeing what happens. I think we've also got a couple scenarios here, guys. You did have the bearish crab pattern. You reached your high, you had your first high, second high, and then you dumped. Now you could be working on something like a ABCD pattern. So you could be seeing something like this, where you've got your X to, or your A to B, which is like a 61.8% retrace, which is perfect, golden retrace. And then your C to D leg. So you could just be catching a little bit of a reaction here before you dump again. And look where that would take you, right down to that $90, $95 level. So that's one thing. That's a bullish structure. You come down here, you create your first low, second low, and then beautiful trade setup. Much more low risk than where you're currently at. Don't get me wrong, guys. You did get back above the zone. So who knows? Maybe you hang on here and, maybe you break the downsloping trend line and you're back off to the all-time high. Maybe you're working on another bearish harmonic like this and you're in the C to D leg. I don't know, but it's just a little too risky for me because I would like to see it fall a little bit further. So maybe you're working on something like this, like a bearish shark pattern, and you're in the C to D leg. That would take you to the 886, which would take you back up to the all-time high. Maybe you need to test it again as resistance before dumping again, and then that could set up like a bullish 5-0. You have your bearish shark pattern, you run to the all-time high again, test it as resistance, sell off 50% of the way, and then run again. Who knows, guys? I have no idea. We just have to wait and see. But when you look at it from where it's sitting right now, beautiful that it got back above the zone and back tested it, right? Exactly what we want to see. The oscillators currently sitting at 54 on the daily. We got back above the bearish control zone. We're headed back up to test the bullish control zone. But we've got hidden bearish divergence from this high to this high. So that is implying a continuation to the downside. So guys, what this could be doing is it could be running back up to test the trend line again before dumping again. Just got to wait and see. If it doesn't, this could be really nice. I mean, if we flip the chart over, you can see, I mean, you had your bullish crab. If you look at it from upside down, you had your reaction, second higher low, and then rallied again to create a higher low. So where would it be headed, guys? That way, down, right? Down. It looks to me like it's headed to the downside. It doesn't look like it's headed to the upside. If you look at the chart inverted, you're making higher lows, higher highs, but in reality, that's lower highs and lower lows. So until we get a higher high, until we break that 242, I'm not interested, guys. Until we can make a true momentum shifting structure implying that sellers are exhausted, done selling, I just can't get behind it, guys. With the market conditions that we're in right now, valuation metrics, I wouldn't touch it until it gets back to 99 bucks. If we jump over to the weekly chart, though, I will say we've got a bullish divergence in development on both oscillators. We just got back out of the bearish control zone on your relative strength index. You had a really nice bullish engulfing candle once you broke the zone. So who knows, guys? Maybe this is it. Maybe you're working on a bullish bat pattern, which would be a huge structure, but that would take you all the way down to 67 bucks, just like what we saw on our valuation metrics with the price to free cash flow and the discounted free cash flow sheet. Now, this is what I would like to see. You've got a big bullish harmonic, brings you all the way back down to the IPO price. Then you could get your, first low, second low, and just set up a beautiful trade setup before heading to way higher prices. So For me, guys, it's just a little overvalued at these points. I just don't like what I'm seeing on the chart with the lower highs and the lower lows. I just think that, yeah, sure, you're going to catch a reaction when you hit a major inflection zone like you did back here, but you got to wait and see follow through price action. If it can, rally here and run back up, get back above the previous high, we're in good shape. Like I said, on the daily, you do have that bearish shark pattern that could turn into a bullish 5-0 and head to higher prices, but you've just got to wait and see. So let me know what you think down in the comments, guys. I think this is more of where I think it's headed, down here to create the C to D leg on the bullish bat pattern. You did break that 50% mark, so you should see a bat action magnet move, which mean it just has a high probability of finishing that C to D leg once you break the 50% retracement mark. So let me know what you think down in the comments, guys. Overall, I think it's a good company. I just need to see the price fall. This video is for entertainment purposes only, guys. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come over and join us at the Patreon if you want to see all of our trade setups, and I'll see you guys in the next one. Peace.